So picture this. You're renting right now, you're paying £500 per month in rent, and you're a first time buyer. You realize that by taking out a mortgage to own a place, your mortgage repayments will be less than what you're paying in rent right now. You think it's a great idea. After all, it's a no-brainer. Who doesn't want to save some money, right? But you apply for this mortgage and the lender tells you you cannot afford the house or the repayments. That's going to change August 1st. It's a huge boost for first-time buyers. That's what we're going to be talking about. Let's get straight into it. Now, I have to level with you guys. This is one of the things that I've struggled with throughout my career in financial services. I mean, I'm a qualified mortgage advisor. I've seen this time and time again. And having to explain to people the rationale that the banks have and the lenders have around this is kind of like, it doesn't make any sense. Common sense tells you if you've been spending years paying rent that you can afford, that you're going to be able to afford a mortgage which is less than said rent. Common sense doesn't always prevail though, at least until now. So I'm going to be talking you through a few things that you need to know. But essentially, this right here is the scenario that we've just described. So you're renting, it's costing you £500 per month right here. And if you take out a mortgage, it's going to cost you £450 per month. Hey presto, fantastic. Now, the reason why most people have found themselves being turned down for a mortgage on affordability basis is because of affordability tests. Those things are being scrapped on August the 1st. But in order to understand how this works and what's actually changing, we need to talk a little bit about standard variable rates, or SVRs. Now, a standard variable rate is a rate that a bank or a lender will set. And typically, if you have a fixed rate mortgage, be it 2 years or 5 years, the minute you come off your fixed rate mortgage, you're going to be going on to a standard variable rate. Now, you can't talk about a standard variable rate without talking about the Bank of England base rate. Now, remember, this has been in the news quite a bit over the last 6 months because we've seen 5 interest rate hikes in the last 6 months. So the Bank of England base rate right now is 1.25%. Now, the standard variable rate is typically the Bank of England base rate plus a number. So it could be 3%, okay? Now, the average standard variable rate in 2021 was 4.41%. But essentially, what the affordability test is, the banks will say, right, we need to factor in the risk of you being able to repay your mortgage over the long term. Now, remember, most mortgages run between 1 to 30 years. You have 35-year mortgages, and you might be here buying your house day one right here. For a 30-year mortgage, the bank wants to mitigate the risk. They want to manage the risk as much as possible. They want to know that 5 years down the line here, you're still going to be able to afford your mortgage, even if interest rates have increased like they have done recently. And so what they would do in an affordability test is say, right, and again, I'm going to use this one right here, the 4.41%, which is the average in 2021. They will say, right, we're going to take the standard variable rate and we're going to add another number to that to stress test you. That number is 3%. So all of a sudden, the reason why you're being told that you cannot afford a mortgage, even though the mortgage payment is going to be less than what you've paid in rent, is because the stress test, the affordability test, is now putting a 7.41% stress test measure on your repayments now into the future. So this is how the affordability test essentially works, and why so many people have been told that they can't afford a mortgage when common sense tells them that actually you can, because you've been paying more in rent than you would pay in your mortgage for your remortgage payments. Mind blown, right? It's stupid. It's absolutely ridiculous. Now, there are still a few things that are going to remain. So some of the things that are going to remain will still be credit history, credit score checks. And again, you have to really make sure that in the run up to you applying for your mortgage, at least 6 months before applying for a mortgage, you want to make sure that you are tracking your credit score, because a clean credit score is essentially going to give the banks no excuse, no room to say, we don't like this. We are either going to say no, which can be rare sometimes, and that there's something really, really bad on your credit report. The other thing that they tend to do more often is increase the interest rate. And that means that your payments on a monthly basis are going to be even more than what it would do if you had a clean and healthy credit score. So always make sure that you're checking your credit score on a regular basis. You can have a look at apps like ClearScore that will help you track it on a monthly basis, and it will give you suggestions around how you can improve your credit score. In fact, I'm going to leave right above here a tile for you to go watch a video where I talked about how I increased my credit score within the space of 30 days. So the other thing that isn't changing, is still going to be integral to the mortgage application process, are your income multiples. So i.e. how much you can borrow versus the amount that you earn. Typically that is around about 4.5%. So let's just say you are earning £25,000 per year. You would times that by 4.5, and that will get you to £112,500 that you could borrow. Those multiples are still going to stay put. Now, there are some providers out there, and again, I did a video, I will link that up right here, that are now allowing people to borrow 7 times their income. You have to be in certain job sectors and in certain roles to qualify for that, and you have to earn a certain amount as well to protect them from a lender's point of view. But a lot of people will still find that useful. So go watch that video right there if you want more information on that. But your income multiples are going to remain the same. Now, I think that this is a positive development in the mortgage space. I think ultimately it's going to allow for higher acceptance rates when it comes to mortgage applications for first-time buyers as a whole. I also think that the banks will probably take a little bit of autonomy around how they actually apply these stress tests. And where I think that this could really help is, for example, for low income households who may be remortgaging, for example, or looking to get on the property ladder, but where they have a really strong, clean credit score, they may get accepted, whereas before they might have been told no. So I think this will be a positive thing altogether. There has been this kind of worry that this is going to mean a free-for-all. And again, I did a video last Friday talking about the new zero deposit mortgages. And one of the things that I mentioned in that video is your affordability. And the affordability ties directly into this conversation. Again, I'm going to link that video here. Go watch that. Because if you are a first-time buyer and you're worried about your deposit, that's really, really good news for you. There are mortgages now where there are zero deposit required. I'm still waiting for a little bit more information about what that proposition actually looks like, so I can do a breakdown of what the repayments will be if the interest rates are going to be higher. And there's lots of question marks, lots of things we don't know. But I hope that this has been really, really helpful. This is going to be a boost for first-time buyers in this country. It's going to lead to higher acceptance rate, more people getting on the property ladder a lot sooner. And for a change, the financial services sector is actually doing something that actually aligns with just common sense. I can't tell you how much it used to really annoy me having these kind of conversations with customers who were so disappointed because you were paying more in rent than you would do if you took out a mortgage. Thank God common sense is prevailing.